Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today we have a special treat for you, Danielle DiMartino Booth and Peter Boockvar. Danielle spent the better part of a decade advising Dallas Federal Reserve President Richard Fisher on monetary policy and the financial markets. She now runs an economic consultancy, Money Strong LLC, where she writes a widely followed newsletter on what the future holds, given the uncharted waters in which we now find ourselves, with central bankers more powerful than any politician in the world. And Peter is the chief market analyst with the Lindsay Group and the co-chief investment officer with Bookmark Advisors. Welcome, Danielle and Peter.
Hi, Rich.
Thank you for having us. Hey,
Great.
Peter, how are you?
Rich, did we lose you?
Yeah, so...
I'm sorry, I'm still here. Are you still there?
Yeah, still here. And so I thought we'd kick off the discussion today with what your views on the financial markets, what's happening, and how it's being affected by what Trump may or may not do in terms of infrastructure spending, free trade, and corporate taxation reform. Peter, do you want to kick it off?
Sure. I think the market's obviously celebrating the possibility of major tax reform, regulatory changes, and also infrastructure. Even though I think infrastructure is not going to happen anytime soon, I think the main focus right now is tax reform. I think the trade issue is not necessarily going to be one thing. It's potentially going to be a variety of things as things progress rather than anything particularly planned. I'm afraid it's going to be more ad hoc with this administration. But the market, I think, is really generally celebrating the possibility that we can break out of this 2 to 2.5% type GDP range over the next couple of years, driven by tax policy that's more conducive to capital investment, which has been a drag on GDP, and certainly a releasing of the regulatory noose that particularly small businesses have felt. That's the optimism. Question is whether it's going to get passed and when it will be impactful. I think that if it does pass, this is not something that's going to happen until late summer, early fall. So we're not going to necessarily feel the impacts until 2018, 2019. In the meantime, there's still challenges that the U.S. economy faces, both in terms of U.S. growth, global growth, and certainly a change of monetary policy and a different direction in interest rates globally.
Danielle?
Well, I have to agree with a lot of what Peter said. I find the market's behavior right now to be somewhat surprising, but not really. When markets are hankering to melt up, and obviously I think there were probably a lot of technicals involved when Trump won the presidency. I think that we've had probably quite a bit of short covering as well. But there's a tremendous amount of optimism going into the new year. But as Peter said, it's really going to come down to timing. And I worry that the pattern is going to repeat itself. That is, that you buy the rumor, sell the news, and that after Inauguration Day, we might see markets take a step back to incorporate these higher interest rates are going to be on the real economy, not just here, but abroad.
And so do we think that any of these are likely to happen eventually, or will there be stumbling blocks in terms of infrastructure spending, corporate tax reform? Any ideas?
I think infrastructure spending is going to be job number 2 in terms of what the administration is going to focus on. They want to get this tax bill passed, and they need to do it in as revenue neutral as they possibly can. So spending $1 trillion. I mean, the Congress already passed an infrastructure bill last year. That is not a priority right now. It's trying to figure out how to get this tax bill passed. And one of the major ways of funding it is this border adjustment theory that is essentially a form of a VAT tax that there's already major pushback to it for those companies, such as retailers and Walmart being one of them, to it. So that's a big fight on their hands, and I think they're going to expend the most amount of capital on that. And infrastructure spending is not happening anytime soon, and shouldn't even be part of the discussion right now.
Yeah, and I would have to add to that I think a lot I think that Trump will be expending quite a bit of his political capital, what he has, on making good, especially for the sake of the party, on appointing somebody to the Supreme Court right away. And again, I think that will be more of a focus in the first 100 days, as well as gathering up the actual monies that are needed to push through the infrastructure spending. So in terms of being able to put people to work right away, I'm not quite sure what he'll be able to accomplish on that front moving forward. And I would go back to, as well, the fact that in February of 2017, we'll officially kind of be at the third longest economic expansion in post-World War II, in the post-World War II era. And you have to ask yourself the question, absent an immediate form of stimulus to the economy and other signs that we might even be seeing slowing, if you look at where we are on a 4-month run rate compared to where we were for the prior 2 years, we've actually slowed down appreciably in terms of economic growth. The question becomes one of, is this economy going to die of exhaustion? Economic expansion going to die of exhaustion? Janet Yellen would tell you, no, these things never happen. But I would have to say that at some point, history will start to test the boundaries of the length of this recovery.
And to add on to what Danielle said, and what she said earlier, is interest rates are moving higher, whether it's Fed generated on the short end or it's a move higher on the longer end. And historically, those long-time expansions have been tripped up by rises in interest rates. So this is not going to be any different. We all have to remember what got us here. And what got us here was a decade of zero interest rates and massive quantitative easing. And now we're seeing no quantitative easing, at least in the US, and rising interest rates. And we have built this economic and market construct that's been addicted to low level of interest rates. And that world is beginning to change. So we can all be excited about Trump liberalizing the US economy, but he still has to deal with the unwinding of what I call, and I'm sorry to be hyperbolic because I can view it no other way, but the biggest bubble we've ever had. And that's going to be an adjustment that's not going to be painless, as there's no free lunch to what our central bankers have done. And I'm sure Danielle can add a lot more detail to that.
You know, and that's really true, Peter. The whole notion of a free lunch and treating the victim with the same medicine that landed the victim in the hospital. In other words, lower for longer inflated the largest housing bubble in U.S. history. And the only thing that policymakers at the Fed could come up with as a solution to solve that was lower for even longer. And, you know, I joke with people like you, my friends, that we're not dealing with a situation in which we're staring down the barrel of a singular individual bubble. Right now, it feels much more like the economy, the global economy, global asset markets are wrapped in bubble wrap. Because if you name the asset class, it's very difficult to provide a cogent argument outside of 1998 and 1999 for the stock market that could even begin to imply that bonds and stocks and commercial real estate and high-end residential real estate are not more overvalued than they've ever been. And that, I think, is going to present a formidable challenge to Trump as he comes into office with, you know, when Reagan was stepping into a similar situation, consider that the price to earnings ratio, according to Bob Shiller's CAPE measure, was 7, a single digit. Yep. It also happens to be the last time that the market was trading at a single digit multiple. And today he steps in with something closer to 27. So extraordinarily different backdrop. Right.
And a different backdrop of interest rates, a different backdrop of debts and deficits and growth, and quite a difference.
So given the trend of rising yields, interest rates, do you think that that this will this trend will persist? And if so, at what point does it actually become a challenge to potential infrastructure spending, given the lack or the stalling in monetary stimulus?
Well, I mean,
Daniel,
that's the trillion-dollar question, isn't it? And again, it goes back to, in my view, politically speaking, it goes back to the support that Trump is going to find within his own Republican Party. And you can pass spending bills of the magnitude of something like an Obamacare much more easily if borrowing costs of the government are 1.8%. The dynamic changes very quickly, and Peter's done some beautiful, elegant, simple math on this. But for every 100 basis points of an increase in borrowing costs, the calculus becomes much different up on the Hill.
right.
I'll let you jump in there, Peter.
Yeah. So in the Fed's flow of funds statement as of the third quarter, if you look at total U.S. debt, not includes the corporate component, and then obviously a lot of small businesses. You include state, local, federal government. You're talking $47 trillion of debt. So simple math is 100 basis points. That's $470 billion of a higher cost. Now, granted, not all this debt matures in the same year. But the point being is that over the next couple of years, we have massive debt maturities that come due, and that's going to happen at a higher cost of capital, and higher interest expense is going to eat into the benefits of lower corporate tax rates and other regulatory let-ups, so to speak, from the government. I know Danielle wrote a piece on commercial real estate, and she mentioned that next year alone is $400 billion of just real estate debt that is due that will be refinanced into higher interest rates. So when you create a debt bubble and then you get a rise in interest rates, well, that's going to hurt people that are too over-levered and don't have enough cash by the in the bank to offset that.
You know, and I would add to that, for this mountain of debt that's coming due to be refinanced, the Federal Reserve was always able to step in. We've had several kinds, if you will, when walls of maturity were coming due, but every single time the Fed was able to step in and mitigate the pain by injecting another form of quantitative easing into the system. I would venture that they don't have that same luxury this time around, and that rising interest rates could present a formidable challenge. And you add to that the sheer amount of supply that's coming online, whether you're talking about the hotel sector or the multifamily sector, the absolute amount of shadow inventory that is weighing down on the office sector. And don't even get me started on what's happening with retail. And I think we'll be seeing quite a few statistics come out after this holiday shopping season, with more announcements of brick and mortar locations closing. And at some point, the simple number of units of supply, if you aggregate it across the commercial real estate space, imply that refinancing is going to be extremely difficult, because you won't be able to generate the level of income needed to offset the level of income needed from any given property that needs refinancing, offset the increase in interest rates.
And that's a great point. You can even draw that line even broader, in the sense that we have too much capacity in real estate, and the economy overall, capacity utilization and the industrial production numbers figures are only running at about 75%. The long-term average is 80%. So Trump can lower taxes to zero, but we still have to work through the excess capacity that has been built up in a variety of industries, driven by easy access to money and borrowing. So this excess capacity overhang is going to take years to work its way through, regardless of Trump and the policies that he passes.
And if we look at the international factors, so now we've been looking at more domestic factors, but internationally, if we see Europe in a mode of disintegration, also Japan, unfolding banking crises, challenges with their economies, with their financial situations, how is that going to affect in particular, the U.S. financial markets and the U.S. dollar?
I mean, I'm of the belief that Europe is just going to be is plagued by the same thing that's been plaguing them for a while: slow growth, enormous amount of debts, and now, unfortunately, the ECB that has totally distorted their entire financial system, and that at some point next year is going to be, that in itself is a major dynamic that we're going to have to deal with. The European bond markets are wholly unprepared for any rise of inflation and any taper whatsoever. So that's something to watch, but that's a timing issue, and I'm not sure if that will matter towards the middle to the end of next year. I think China should be in the forefront again because they're trying to deal with a massive debt bubble, trying to moderate their property market without crashing it. We're already seeing a rise in interest rates across the board there, potential tightening of credit. I'm more worried about them than I am of Japan. Japan is just a muddle along, and it's been that way for a long time. Now, granted, Japan's bond market will be part of the global rise in interest rates that we've already seen, so that's going to be important. But yeah, to your point, I think this is all going to be very relevant next year. And with markets, as Danielle said, extraordinarily overvalued in many different asset classes, there's no room for error here. There's no margin of safety, and a rise in interest rates across the world can really upset this apple cart.
Agreed. Absolutely agreed. And, you know, I would add that there will be a lot of focus in the coming year, not specific to China. There'll be a lot of focus in the coming year as it pertains to how quickly they're going to run through those reserves of theirs. And separately, we have major changes of power when we think about Mario Draghi and Janet Yellen leaving office in 2018. And presumably, after one more year of footing the bill for this migrant crisis in Europe, there's a good chance that Germany will have much less in the way of appetite for continuing to write these checks. I don't think that the political unrest story has played its way through. And you know, it's interesting, there's a new survey that Bank of America Merrill Lynch produced today that showed that bond investors worldwide, these are investment grade bond investors, we're not talking about emerging market junk bonds or anything of that nature, but for investment grade bond investors, the number one concern over the next 12 months is populism. So I think that these themes are going to they're going to storm back into the headlines. And I think that'll probably end up taking some of the froth out of the markets in the early part of next year.
Will all of these international factors cause increased international capital flows into the U.S., thereby driving U.S. markets higher, and perhaps the U.S. dollar stronger, potentially giving the ability for the Federal Reserve to do additional monetary stimulus given a stronger dollar to keep interest rates low? Do you see any of that?
Well, on paper,
well, that's the Goldilocks. Yeah, Peter's taking the words out of my mouth. Yes, exactly. Go for it.
Yeah,
Peter.
on paper it sounds right, but the cost of hedging out your currency risk has gotten to the point where it's not profitable to do so unless you can get a really high rate of return. If you're just trying to sell your local sovereign bonds in Europe and Japan and hoping to buy U.S. treasuries and capturing a spread, well, the cost of hedging out your currency risk eliminates that completely. You know, it's very easy. Okay, I'll just go into that market, but there's major currency risk that you take when you do that, and it's easier said than done. And you know, I'm looking at the chart right now and the cost of hedging at the euro, and we're right back to the highs again, meaning the most expensive it's been in this move. So that is an impediment to money coming here. Sometimes when you get distress, like you talked about, a lot of times money actually stays home and it's repatriated and it's kept at home to deal with their own issues.
Yeah.
You know, just dovetailing on that, I think that one of the potential unforeseen hiccups going into 2017 and 2018, as we see the potential for the global economy to slow more, is that there might be a need for a lot of the money that has flowed into the United States commercial real estate market from foreigners to go back home. And I don't think very many people are talking about that right now.
And what about
Another
protectionism
great point.
on free trade? Like if the economy slows and there's increasing populism, which may cause rising protectionism, how would that all factor into to trade and then the effects on the markets?
Well, again, I'm not potentially as pessimistic about this, simply because it appears that Trump has put some rational people in with him, and hopefully somebody at this point has told him that China does not qualify on paper to be a currency manipulator. So I'm going to try and be hopeful about this, especially because in places like where I live in Texas, there's very much a symbiotic relationship between Texas as an exporting state and Mexico as an importing and exporting country. So I will hope that there aren't too many counter tariffs, et cetera, that are launched, because that could abruptly slow the economy.
And even just the threats of it from Trump is enough to slow things down. Because if you're a CFO or CEO and you're debating whether to make an investment somewhere, are you going to get tweeted about, or are you going to get a phone call from somebody? So that in itself can halt the proper allocation of capital here. And we're already seeing foreign politicians. I think it was a French politician that said, well, if Trump is going to slap something on us, we're going to slap it right back. And we know there's already a back and forth with us and China. And again, nothing substantive may happen, but just the threats and the chatter of it sort of freezes in investment decision making, and it creates its own problem there. I mean, that capital investment has been the major drag on U.S. growth, and I don't think a lot of this commentary is going to be conducive to helping out. Hopefully, we can get past it and people says, oh, he doesn't really mean what he says, but if he keeps tweeting and making phone calls to CEOs, that's going to be a big enough threat to slow the proper allocation of capital.
I concur.
And there seems to be a trend as well in currency or cash, physical cash. We have India getting rid of 86% of their physical cash. Venezuela has been getting rid of their high notes. Australia has a similar initiative. The U.S. there's been some talk about the $100 bill. Do you see this as a trend, and how will this affect the macroeconomic situation and the markets?
Well, I, for one, hope that the trend ends. That's about all I have to say about it. I think with Trump in office, the opportunity to put some rational people at the head of the Federal Reserve who do not want to abolish cash, as Ken Rogoff might, again, I'm starting to sound like an optimist, which means we might all want to run out after this ends and buy a lottery ticket. So.
Okay.
Yeah, I agree. I think the whole cash thing, you'll have many people in this country revolt if they threaten to get rid of any denomination of cash. I mean, this country is much less conducive to pull something like that off. And in India, I mean, I understand what Modi was trying to do in the sense of so much of their economy is underground and so much of it is cash and barely anybody pays taxes, and it makes a lot of sense. But if this is something that's morphing into we're going to watch every penny you spend because it's going to be all digital, well, that gets into a more dangerous situation. But I think a lot of this is more talk than action, particularly in the U.S., because of just the nature of our country and people that want their freedom. We voted for Trump because people were anti-establishment, and getting rid of cash is the epitome of an establishment type move.
Yeah,
and I will add something in the same sense that our central bankers here have been able to benefit and learn from Japan's failure at implementing negative interest rates. Listening to a friend of mine who's got manufacturing facilities in India, and now she has literally seen her employees disappear, like kind of the stuff that conspiracy theories are made of. I think by that same token that central bankers worldwide will have a blueprint of how to not eradicate cash because of how severely it's impacted India and the people who live inside the country who've just been devastated by this.
And recently, Danielle, you have written a great essay on the Federal Reserve and its effects on the American dream. Speaking of freedom and central bank policies, can you elaborate on that essay? What you were trying to get across?
Well, so the Federal Reserve and the destruction of the American dream. It was a very personal piece that I wrote. There were a lot of before and after 1982, Reagan stepping into office, Trump stepping into office then and now. And when I saw that the household debt to income ratio in 1982 was 62% compared to where it is today, kind of 130%, something occurred to me that even though we've had quite a bit of deleveraging, much of which has occurred through the channel of mortgage foreclosures, more household debt has become a way of life for Americans. And that was more what I was speaking to. The average American family today has $1,600 in credit card outstanding debt, and sorry, $1,600 in average credit card payments, excuse me. And the interest rate before the rise in interest rates was around 19%. Revolving credit card usage has gone up over the past 12 months. And that just tacks onto what's happened since the housing market imploded, which has been people being forced into the student loan market to be able to afford their higher tuition, to say nothing of 1 out of every 4 car loans in this country being subprime. I understand it's a much smaller market, but the piece I wrote was much more a reflection on how much our culture has changed since Alan Greenspan basically took over the world and infected our way of thinking into believing that we could placate the masses, that the central bank can placate the masses with household debt and making it accessible rather than forcing the government to make some much more difficult choices and allowing us to continue to be a save and invest economy. And I hope, my true hope is that we can find our pathway back, because other countries that have different cultures than ours have their sights set on the weaknesses that it has exposed in our social fabric.
Peter, your thoughts?
Yeah, and it's an amazing point. I mean, when you take a step back, and as noble as central bankers think that they are, particularly the very dovish ones, in theory, in practice, all they're doing is encouraging you to borrow money. Whether you're an individual or you're a corporation, they want you to lever up. And that's why they think lower interest rates is good, higher interest rates is bad. And it's obviously nothing is black or white like that, but that's what they want you to do. Now we've reached a point where the U.S. economy has levered up to such an extent that we are so sensitive now to any changes in interest rates in financing that debt. As opposed to creating a savings and investment culture that Danielle talked about, we've turned it around and created a borrowing and spending type culture instead. And that has to shift around and reverse itself, but it's not something that is a smooth process. It's a messy process, but a needed one.
Yeah, not to mention also the effects on the American dream for the retirement years, whereby low interest rates or zero interest rates effectively have made it very difficult for retirees to live on fixed income, and also on effects on pension funds, right, for retirees and pensioners that are relying on their pension funds, private or public. These funds are having very difficult times in meeting their requirements for payouts due to the low rates. Any thoughts on that?
Well, I could probably spend a few hours talking about pensions, and I'm kind of in the middle of pension ground zero here, where we actually had a run on the Dallas police and firefighters pension. So and again, Dallas was probably perceived until these headlines started to run as being part of a very strong state. But you peer underneath the hood and you come to find out that Dallas and Houston and Austin and San Antonio are on the top 15 list of some of the most weakest funded pensions in the country. It's not just an Illinois-centric situation. But I worry terribly about the idea of compounding when it comes to pensions. I don't know that there's enough ground. I don't know that there's enough time to make up for what's been lost by the assumed rates north of 7% not being compounded all these years and having actually gone in the other direction, to say nothing of what happens when the markets correct, taking down the liquid part of pensions portfolios, leaving them with the understanding and the realization that because so many have piled into private equity investments in recent years, as they've turned their backs on hedge funds, that they're not only invested inappropriately in terms of the risk, when you're taking grandma to Vegas, that private equity is not only an inappropriate investment risk-wise, but a devastating investment because of the lack of liquidity.
And to follow up, to Danielle's point, is that pension funds are piling in to real estate at the peak of a cycle. They're piling into private equity just when there is a possibility that the Trump administration is going to end the tax deductibility of interest expense on new debt accumulated going forward, which dramatically damages the entire private equity model. It's chasing yesterday's winners, a classic case of it.
And pensions have done it over and over and over again. And you see headlines like Vermont's Governor-elect Scott has come in with some innovative ideas in terms of how to reform the pension, and immediately it gets shot down by the treasurer, and you move on. I'm concerned when you look at the example of Illinois and the city of Chicago, whose murder rate is unprecedented. I'm gravely concerned about what happens when public services start to get cut, because the judiciary or the legislature, you name which of the two, refuses to bend on the need for, as terrible as this may be for pensioners, but on the need to reform pensions, even if that means haircuts and shifting slowly to 401k type plans.
Right, because they're not being honest with their constituency, who think that their retirement money is there. That money does not exist. It is not there. But there are politicians out there, they're not being honest with their constituency.
And this is with home prices back up at their highs, by the way.
Right, and stock
what
market
happens when
at
revenues
all-time
take
highs.
A hit again?
Right, and bond prices at record highs.
Danielle, do you see the possibility of federal government bailouts on pension funds or in municipalities?
Well, bear in mind, the Republicans tend to want to push these types of responsibilities to a greater extent back onto the states. So I think that the political appetite for bailouts is going to be very, very low. Could it be possibly forced in time? Possibly. But again, we've got 4 years of somebody in the White House who I promise you will veto these measures.
Wow, we live in interesting times. How can our listeners learn more about your work, Danielle?
Well, you can always go on and subscribe. I'm not a for-pay platform quite yet. Go on to @DiMartinoBooth.com or follow me on Twitter @DiMartinoBooth. Sign up for the weekly. Look at the archive. Have a peek. Go on Amazon.com. Buy my book, Fed Up: An Insider's Take on Why the Federal Reserve is Bad for America. Real subtlety in that subtitle. And look for the book to come out on February the 14th.
And Peter?
Yes, make sure to buy that book. You can follow me on, publicly, bookreport.com, BOOCK report.com, Twitter, Boockvar, and email peter@thelindsaygroup.com or peter@bookmarkadvisors.com.
Great. Thank you very much, Danielle and Peter. We'll be back after the holidays for another edition on the first week of January. Happy holidays and New Year to everybody.
Thanks, you too.
And to you. Thank you. Appreciate it. Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.